Hello, my name is Craig Smith, Chairman of Swiss America Trading Corporation, and from time to time I'm going to come to you on these little video chats and try and share with you some of the things that are going on in the economy and quite frankly that are going on throughout the world economy and how they affect you and your family. You know, it's interesting when you start hearing all the economic commentary and geopolitical commentary, and it all sounds great, but unless we can boil down that economy to how it affects us in our daily lives, it really doesn't make much difference. I mean, let's be honest. When I drove to work today, I was shocked to see on the street corner that for the first time, and I can remember at least the last 6-7 years, gasoline prices were $1.67 a gallon. It's wonderful. A lot more money in people's pockets to spend. And of course, we're going to hear that Saudi Arabia did it and President Obama will take credit for it. And I find that fascinating because, you know, President Obama could also, I guess, take credit for Americans losing $6,000 worth of buying power and real income over the last 6 years. But I'm going to do something different today. I'm going to actually defend President Obama. Some of you are probably shocked by that, considering I've been one of his biggest critics for the last six years. You see, the president doesn't make prices go up or down. The president has no more control over the economy and economics than you or I do. What the president has the ability to do is create an economic environment of stability, of confidence, of consistency, of lower regulations, of less bureaucratic red tape. That will create a stronger economy in America. And so that's why in these little video chats, we're going to be talking about certain policies that, quite frankly, don't have anything to do with the president. They have to do with the central banks around the world. They have to do with corporate America. They have to do with the bond markets and the debt markets and how they ultimately affect you. And so today I want to give you a slight example of what we see happening in the stock market, because everybody's talking about, look at this Dow Jones. It was at 6,600 during the crisis in 2008, and all of a sudden here we have it at 18,000. And some people are saying if Janet Yellen and the Federal Reserve get their wishes with a quantitative easing number 4, which, by the way, on our book, The Inflation Deception, we talk about we could have quantitative easing 25 one of these days, as much as I like to print money in America. But it's interesting that if they get their way, what impact will this have on you and I? And what impact will it have on the stock market? Well, let's look at what quantitative easing has had on the stock market. As I said, 6,600 to 18,000 sounds terrific, doesn't it? But I want to show you something that happens in the stock market today that most people are unaware of. And I'm going to do it via illustration on a whiteboard, because I think it's the only way that you can really get a feel for how this works. Let's take, for example, you have a company by the name of IBM. Okay, and my handwriting is not very good, so bear with me. And I'm going to just use a hypothetical here. Let's say they have 10 million outstanding shares of stock. And those are stocks that are held by you and I and institutions around the country. And they go out in the bond market and they borrow a couple $2 billion at 2%, which is basically nothing. Now they have all this money. What do they do with it? Well, they go into the marketplace and they buy 5 million shares worth of stock. Now there's only 5 million shares of outstanding stock. Now, let's say when that 10,000 shares was still out there, they had earnings. And again, this is all hypothetical, all just simple numbers so you'll understand the concept. Let's say they made $5 million worth of profit. Okay? That means each one of these shares had a 50-cent per share profit or dividend. You were paid, it's a company that pays a dividend, you're paid a 50-cent a share dividend, or you made 50 cents per share income. But if they go in and buy 5,000 shares, and now there's only 5,000 shares outstanding, and they still make $5 million, how much have you made per share? You've now made $1 per share. And nothing has happened except fuzzy math by the government through the Federal Reserve, allowing IBM to borrow money at what are called ZIRP, zero interest rate policy rates, and they can buy shares back and make the earnings of their stocks look like they're higher. Now, here's what's interesting. I did a little homework, and I'm going to have to refer to some notes here because I want to be as accurate as I possibly can. There was a group that went out and did a little study on all this, and they found out there's a company called Pelham Smithers, and they did it through the BlackRock Corporation, which is one of the largest hedge funds and investment companies in America. Huge company. They did this in 2015. And you know what they did? They looked, if they were to take this accounting trick out of the equation and they say, we don't do business this way anymore. We're going to do it the old-fashioned way. We're not going to allow companies to float 2% bond issues and buy stock back so they can improve their earnings. And again, I'm not saying IBM did this. This is just a hypothetical. This could be Xerox. This could be Google. This could be any one of them, okay? But guess what happens to this $1 a share? Their report shows that the S&P earnings for the same time period, oops, I'm not doing too well here, am I? Would be down 86%. That's right. In other words, if they had to play by free market economics and not by the economics that the Federal Reserve allowed to have happen, that S&P earnings would be 86% lower. Now you're saying to yourself, well, Craig, just as long as I'm on the right side of this trade, I'm okay. And that's absolutely correct. Your stockbroker probably has you on the right side of this trade. But history shows us that anybody that manipulates markets, like we saw during the dot-com bubble of 1999-2000, the great American stock market crisis called the Great Depression in 1929, where high leveraged finance was distorting market prices. Or if we go to the 2008 housing crisis, where cheap interest rates and financing anybody that had a breath made a housing bubble explode, they ultimately end up paying for the manipulation. And we saw that to the tune of billions and billions and billions of dollars of losses in 2008 through 2010. Yet isn't it fascinating how the American banks, and you know the big ones I'm talking about, Bank of America, JP Morgan, Mellon, New York, I mean all the big guys, Goldman Sachs, how they lost billions upon billions of dollars, and yet within 2 or 3 years, they made all that money back, they paid all that money back to the government, and now they're highly profitable, and everything's just fine with their banks. And that's why I wrote the book, Don't Bank on It. Because when you look at the real numbers like we just looked at here, when you take all the shenanigans and all the manipulation and all the fuzzy math, you'll find out that the banks aren't as in good a shape as you thought. But this is just one simple example